Will the coronavirus make the stock market crash? I'll try to answer that question, do my regular weekly market analysis, a market scan in search of opportunity, and look at the day trade of the week on BIMI. All right, so is the coronavirus going to make the stock market crash? We've seen some weakness this past week, largely blamed on that virus. I would say, however, that the market has gone up a lot since mid-October, and it is certainly due for a pullback. And so whether it was the coronavirus or some other thing, we were ready for some profit taking, and I think that is a lot of what's going on. If we look at the history of the market with these viruses, it tends to be something that goes away. When I think about Ebola, H1N1, SARS, yes, there was some negative market activity around those things, but it was relatively short-lived, and ultimately the markets continued their trend. What we want to do is look at the charts and figure out where support zones are, where the buyers will draw a line in the sand, if you will, and if those are broken, then we have to expect that there's going to be more selling pressure. The short-term upward trends, which are the intraday and the daily charts, those have been broken. And so really what we're talking about here is what are people doing with their money? And so let's take a look at the daily chart of the S&P 500. Now you'll recall that last week I was not too worried about a correction yet because this daily upward trend line had not been broken. Well, on Monday it was broken. And so that was our first clue that we were going to see more weakness. And it took until Friday for us to really start to gather some momentum to the downside. But Friday was a pretty strong day to the downside, and that leaves us having closed the week below the downward trend line, at least in the very short-term sense. Now, the longer-term upward trend line on the daily chart, well, there's a lot of distance to go before we hit that. And if we think about the very long-term trend, and we'll look at the weekly chart in a moment, there's still a lot of room for this market to pull back before it really becomes a major concern. However, when I look at this chart, I say, well, support currently is around $300 on the S&P 500 ETF, SPY. That's a 10% move off of the high. That is a correction. Is the market going to crash with some sort of devastation? I would say at this point it's probably not likely, but we should still keep a close eye on things. So let's get into this week's normal market analysis and we'll see what the charts tell us. So starting us off with the US markets, and there you can first see the short-term 30-day 60-minute chart, and we had that first bit of weakness at the end of the previous week, not this past week, but the one prior. And then we had the gap down on Monday and a little bit of a bounce back that took us to this little downward trend line, and then selling pressure through the day on Friday, and we're essentially in a short-term downward sloping channel. And so that's a negative. And as a short-term trader, you've probably felt, if you are a short-term trader, the negativity in the market. But the big picture, the longer-term chart, is still okay. Here is the upward trend line on the weekly. I could also draw it like this if you want to take that longer-term view. Either way, we have held that. And you can see markets run away from the trend and they pull back. They run away from the trend, they pull back. They run away from the trend, and now it's pulling back. That is normal market activity, especially after market has gained what this one has gained since mid-October. So short-term, I'm bearish, but long-term, I remain bullish because that long-term upward trend line is still in place. Looking at the small cap US stocks, you can see that the little upward trend line was broken here. We've got a lot of support in this zone, and so there's not a lot of downside until we hit that. But I do think short-term, we can probably see some more weakness without really damaging the long-term chart. On to the Canadian markets, and the Canadian market actually hasn't suffered as much as the US. Again, here is the upward trend line on the short-term chart, and of course we had this upward trend line broken there. I think we'll see a little bit more weakness, maybe even breaking this little short-term upward trend line, but in the context of the longer-term trend, we've got lots of good support, and so therefore I'm not too worried about the Canadian market yet until that upward trend line gets broken. Moving along to the TSX Venture, and you can see that the downward trend line has been broken. We're building this little rising bottom. I talked about that last week, and if we can get a break up from this, then we may be finally turning the corner on this market, which has really been beat up. So I think this is a market that should be watched for opportunity, but it's still early. We still need to see that break from that rising bottom before we want to get too excited. On to currencies, and the US dollar has broken its upward trend line a number of weeks ago, and we had a little bounce back rally for about 4 weeks, and essentially it feels like we're just getting up to this now downward trend line, and I remain something of a bear on the US dollar simply because that long-term upward trend line was broken from a falling top, and that is a typical pattern for a reversal of optimism into pessimism. Canadian dollar, despite the sort of weakness in the US dollar, the Canadian dollar still can't really get its act together. It's having trouble getting out of this pattern. But the good news is this is an optimistic pattern. Now, how do we know it's optimistic? Because the bottoms are rising. That means every time the sellers were strong and they were pushing price down, they couldn't push price as low as they had the previous time. And the result is you get these rising bottoms. That's a sign of optimism. I wouldn't get too optimistic, however, until we can break up through this resistance level, because that would really demonstrate that the buyers are enthusiastic about the Canadian dollar, and we're not there yet. So we're stable, we're building optimism, but we don't have the excitement yet on the Canadian dollar. On to interest rates, and last week I said it looked like the bond market was going to move higher because we broke the little, this is called a flag pattern. We have an upward trend. There's the flag fluttering in the wind. We broke the flag. That's a pretty reliable signal that something is going to go higher in the near term. And this week we got that. The bond market went higher, which means interest rates have gone lower, and we remain in a low interest rate environment. Now, the one concern about this is that if interest rates are going lower, it implies that there is some concern about an economic slowdown. And that could be more of a reason for the overall market to actually go through a crash. Forget about the virus. The virus may just be the, pardon me for the term, but the canary in the coal mine here, as really there could be bigger problems for the market. The fact that the bond market is going up like this has me a little bit concerned about perhaps an economic slowdown. And on to commodities. Gold, which is a sort of a safe haven in times of trouble. It has been, working its way higher. We see the break here, and then we see this break here. We are in this upward trend. I don't know if I would want to initiate positions in gold stocks unless they are breaking from good patterns, but the overall outlook for gold is positive, and I would say it remains a hold if you have some of those stocks. Oil, kind of the opposite. It tried to break its downward trend line, didn't have a lot of enthusiasm on that Iran-US tension, and then when that sort of went away, the market for oil fell back. We're now into an area where it should find support. So we're a little bit oversold on oil. It could go down perhaps to the 1050 mark on the USO, but it should bounce in the next week, I would guess. Doesn't mean that the weakness is over. I just think in the short term it's oversold and needs to make a little bounce. But I still am not very optimistic at all about oil because of the recent weakness. And finally, the fear chart. I always like to take a look at the VXX. It tends to do well in times of fear, and we're getting that a little bit again. We broke higher from a rising bottom this past week. I think we could see a little more fear. This thing could go up easily to $19 in the next week or so if we get more market weakness. And so this is a good one to watch because it'll help you to see just how nervous investors are, but also it's a vehicle to make money when the market is crashing. So my ratings then, US stocks bullish long-term still, but bearish short-term. Canadian stocks bullish long-term and neutral short-term. Gold bullish on both time frames. And oil short-term bearish. We are in that sharp downward trend, but we also are at support long-term on oil where it should bounce. And so I've got a neutral rating in the long term. The intraday and daily upward trends have been broken for the US stock market. Not so much for the Canadian yet. But that does indicate we are likely to see more weakness. And this will be headline driven around the coronavirus, but that could in itself hurt confidence a little bit and cause greater weakness. So we want to keep an eye on that. The long-term upward trends still remain intact, so I'm not ready to run for cover for long-term positions, but in the near term, I think you want to be bearish with the short-term trades that you make. Gold is a safe haven, but still a little late in the upward trend to be initiating positions. Oil has fallen to support where it should bounce, and fear is up. All right, so let's now do a Stockscores market scan in search of opportunities. Now, the market scan tool is available to members of Stockscores. It allows you to filter all North American markets for stocks meeting any combination of 30, 40, 50 different filters that we have in the tool. And so what I want to run this week is the action break strategy. This strategy looks for strong price movement to the upside with good volume against a negative market condition where you've got a downward trend and you are breaking the downward trend. It's often a good sign of a reversal. So let's jump over to the market scan now, and from the preset scan pull down menu, I'm going to select the, where is it here? The action candle breaks right there. And we'll run this one. It goes for every stock trading in North America. It found 15, which isn't too many, and that's largely because the market was down on Friday. And so then I cycle through these charts in search of the sort of patterns that I want to see. And of course, every week I try to do this. This is an interesting one because this is an inverse ETF on technology stocks. And so you can see that there's a little bit of life. The volume is climbing, trying to break that downward trend line. Again, if you want to protect yourself a little bit against a market crash, these are the kind of vehicles that will go up if the market does in fact crash. So that's something to keep an eye on. Here's another inverse ETF. This is on the S&P 500. This is triple leveraged, which means it will go up 3 times as fast as the overall market goes down. And you got to be a little bit cautious with stuff like this because of that leverage. If the position is working against you, it can work against you with leverage. And so that means that you can suffer doubly, but it also means that the upside can be very much stronger. Here's one of those inverse ETFs based on volatility. Sorry, it's not really an inverse ETF, but it tends to go up when the market goes down because volatility is increasing. And there you can see, having recently broken the downward trend, now breaking up from a rising bottom. Again, if you're looking for a way to short-term trade a stock market correction, these are the kind of vehicles that will do it. Just, I have to emphasize, they're really tools for more advanced traders. If you can't watch the screen pretty closely, I would be pretty cautious. DXD, another inverse ETF. And so that's really the story this week, is that the opportunities are in those inverse vehicles that tend to go up when the market goes down. All right, now on to the day trade of the week. And the day trade of the week is really for educational purposes, just to demonstrate the sort of day trading strategies I do with our Active Live service. Active Live is where you can watch my analytical screen, the same one that I am using to drive my day trades. I'm entirely algorithmic. It's based on math, and we look for anomalies in the market as good day trading opportunities. And this week, it was a long trade on Friday, despite the fact that the market was weak on Friday. There were still some good long trades. In fact, there was a number of them, and the algorithm helps us find those. So in this case, BIMI made an action candle, which is our key indicator to tell us to take a look at this kind of a stock. You can see that volume was increasing. We have an action candle right there. That's my own indicator. And the stock went up very nicely through the day. From a risk management and sort of the economics of this trade, for $100 of risk, the position size was 580 shares. And so for every $100 of risk was a $2,059 position, but you can margin day trades 3 to 1, which means your broker is going to lend you 2/3 of the capital. And so the actual capital that you have to put up for this trade is just $687 for $100 of risk. It ended the day at a multiple of risk, 8.4, which is our risk reward multiple. That's an $840 gain for $687 of capital, a 122% return for a 1-day hold. Well, that has been the Stockscores Market Minutes for, February 3rd, 2019. Hope that you've enjoyed it. If so, please click on the like button, subscribe to the channel, maybe even set the alerts so that when I upload a new video, you will get an email. Most importantly, leave a comment, tell your friends, and as always, trade well.